Welcome to Integrated Planning, where we take an integrated approach to growing and protecting your wealth. My name is Sophie Blais, and today we're going to be talking about the 6 key areas of financial planning. So one of the things I always talk to clients about planning is that there's 2 sides to financial planning. There is a quantitative side and there's a qualitative side. And any client that's worked with me understands that there's both head and heart answers to the questions that you have about, will you have enough? What should you be doing with your business? Are my family protected? If I can give one word of advice, or you take one thing away from this series, it's that, you know what, it's never too early or too late to work with a financial advisor and an integrated team to make sure that you can live the best life you want to live. The Financial Planning Standard Council outlines 6 core areas that planners should be looking at when working with clients through their financial plans. The first being financial management. So financial management is really simple. Financial management is, simply put, money in versus money out. If you spend more than you have, then you'll end up upside down. And no matter how much money you make, you can still not have enough at the end of the day. There's a couple of areas of financial management that are really important. The first one is your net worth. We often say that your net worth is your scorecard. Oftentimes people look at how much money they make, how much money they save, but really long term it's what you keep and how that grows that makes the most sense. So net worth can include a whole bunch of different things. It can include the assets that you own, the properties that you own. Well, there's lots of net worth calculators that you can access online, and obviously if you're working with your integrated team and your financial planner, they'll help you go through that. But there's 2 sides. There's the asset side and then there's the liability side. On the asset side, you'll often see things like homes, properties, vehicles, jewelry, cash, investments, anything that adds a plus sign to the overall net worth bank account. On the liability side, there's a whole bunch of things that make up the liability side as well. So liabilities can range from, a mortgage on your home or any properties, any loans you might have for whatever different things. If you look at your credit cards, any debt effectively that you owe is considered a liability. So to come up with your net worth, you take your assets, you minus your liability, and you end up with what's yours. Another thing to keep in mind as you're working through financial management is cash flow. Money in and money out. Or any of us that have children, it goes back to, if you make $20 a week in allowance, if you spend 30, you're not managing your budget well. And so when working with clients, both small, medium, and of high net worth, cash flow is often an important discussion because what you make and what you spend have a huge impact on the planning opportunities and discussions that you might have. So budgeting. Budgeting is an interesting word, and oftentimes in the past in working with clients, budgeting, I would joke that it's a 4-letter word. And people either have a love or a hate relationship with the concept of budgeting. But budgeting is really important for most individuals or businesses in terms of knowing, what's coming in, when is it coming in, what needs to go out, and then effectively it allows you to make sure that you put yourself first, right? So if you've got savings goals and objectives, if you've got, debts that you need to pay down or different things that, different obligations that are coming your way, it's important that you have a budget in place. Oftentimes I'm asked, Sophie, what would you use to budget? There's a lot of different tools that are available. There's lots of online tools. People will use Excel spreadsheets. You can access budgeting tools through your bank. It's really what makes the most sense to you. What I always suggest is keep it simple. There's a concept that is important to understand, and we all should be doing it, and that's the idea of paying ourselves first. Right? Making sure that there is money set aside on a regular basis to meet your needs. And so, if you look at some of the compound interest calculators that are out there, you start talking to your kids when they're young, if you start putting $50 away every month, it can really grow. And so we often suggest to clients that they do look to paying themselves first and create a habit around putting money away for the future. And that's a tough thing to do in today's day and age because we like that immediate satisfaction and that immediate, getting something immediate out of what we're doing. So creating the habit, creating the discipline to put money aside is really important. Nobody likes to talk about debt, but debt's a really important topic to discuss, to look at. And I think when you're able to actually have conversations with your advisors or your integrated team about the debt that you have, you can then find a meaningful solution to move your way out of that. So there's a few core tips about debt and what you should do with your debt. The first is pay down your highest interest first. So if you've got credit card debt, which is normally pushing 20%, the recommendation would be to pay that off first and to keep that and keep paying that and keep that balance at zero if you at all can. The second is to look if you can consolidate your debt. There's lots of programs out there which allow you to bring multiple debt together and consolidate that into one kind of payment that you can manage. The other piece is to think about your mortgage, right? So it's an interesting discussion because mortgage is what I would consider good debt. And when looking at debt, there are good and bad types of debt. So credit card debt, bad debt. Mortgage debt, good debt. It's ultimately going to build up your net worth. So those are the key areas, right, when you're thinking about financial management. Your net worth, your cash flow, what comes in, what goes out, and then how you manage your savings, your debt. So the second thing to consider in financial planning is investment management. And I always like to share a story of my first investment experience. So I graduated from the U of S with a commerce degree, and I went up to Prince Albert for my first job. And I went to the bank just like most people do when they start investing. And given that I was young and I had a high risk tolerance, we'll talk about that a little later on, I was put in the precious metal fund. And that precious metal fund was supposed to do great things. Well, to make a short story long, or a long story short, I ended up with zero at the end of 18 months in my precious metal fund. So my initial dive into investment management was not a very good one, but one that did put me on the path that I'm on today. And understanding the importance of proper investment management and the things that you need to look at when you're trying to invest. So the first piece is risk tolerance and objectives. So planning is all about understanding where you are today and knowing where you want to be in the future. And that's no different in any of these aspects that we're talking about today. So if we think about objectives, so your investment objectives, there are a whole bunch of different objectives that you might have. One might be saving to buy a home. The other one might be saving for retirement. Your investment objectives might be to put your children through school. It could be to fund a future purchase. Then the list goes on. And so understanding what your objectives are is really key to knowing what and how you should be invested. Because there are short-term investments, there's medium and long-term investments, and the worst thing that could happen is you end up in something that doesn't meet what your goals and objectives are. So that's important to take into consideration. The other thing is risk tolerance. And that's an interesting one because we all have a lot of tolerance for risk when things are going really well. And we have less tolerance for risk when things are not. Fear and greed are the two motivators that normally motivate people when they're making investment decisions, and a lot of other decisions as well. So we've had, if the markets are on a run, everybody wants to throw their money into the markets. When the markets are down, people don't want to be invested at all and they want to take their money out, sit in cash or sit on the sides. At the end, the reason why you work with a professional team is to take the emotion out of it. Your best opportunity to invest is at the lowest points in the market, and when you should be worried are at the highest points in the market, which is contrarian. And so making sure that you've got a disciplined approach, you're working with the team, will end up delivering the best results. So having great conversations with your investment advisors will ensure that the right objective is put in place for your goals. And having that coach, that gut check person that you can talk to is really key. I've had many discussions with clients who either want to pull themselves out of the market or who want to throw everything at a certain investment. And part of our goal as planners is to have really fulsome discussions about, what's there, where they want to be, how that's going to go. And, ultimately, what is the true risk tolerance of the client, and talking that through. We might all be happy with a 20% gain in our portfolios, but would we be equally as happy or okay with a 20% loss? And oftentimes the answer to that question is no. So those fulsome discussions, really important that they're had, and don't be embarrassed about mistakes that you've made in the past or thinking you might make a mistake going into the future. That's just part of life, and that's just part of your financial life. In investing, like in life, we all have certain biases towards how we invest, what we want to invest in. Some of those are personal. So let's say, for example, you come from a family where there was a big loss, or dad or mom always invested in real estate. Your bias might be towards those things. You may also have bias based on your experience. And somebody that's had a bad experience investing will be really reluctant to make those choices or to go in a certain direction. You might also have biases based on information that you've heard, whether it's from friends or family. We can all think back to, whether it's a cocktail party or barbecue that we've been at, and somebody is sharing the story about how much money they made on XYZ stock. At the end of the day, I always say that you hear about the wins, but you never hear about the losses. And there's always wins and there's always losses. So again, that goes back to creating a really balanced portfolio, having great conversations to make sure that your investments are in line with your objectives. Investment isn't one size fits all. We all have biases. We all have different paths and things that impact our decisions, which is why it's really important that we work with a professional planning team to make sure that we stay the course, we stay on track, and that we don't let our biases shadow a really good decision. So the third area to consider in financial planning is insurance and risk management. I always laugh. Insurance is a dirty word to a lot of people. And it's interesting, when I started in the business, I started on the group insurance side of things. And my dad didn't say I was insurance for many years. And, a lot of people feel that way about insurance. And so the term risk management has come about. But it's a really important topic, one that's often overlooked, one that's often forgotten or put to the side. And it is an area where the impact to your financial plan could be the greatest. So one of the things I want to talk about is that your need for insurance or risk protection products change through your life. When you're young, you have a young family, you likely have a mortgage and a lot of debt. That need for some insurance in the event that something happens to you, you die, is really important. As you get older, your needs might change. Your risk of becoming critically ill or becoming disabled increase. You maybe have a business that you've started, so you need to make sure you've got protection in place for that. But there is an ebb and a flow to risk protection throughout your lifetime. So I think it's important to know that there's a couple of different ways that we normally talk about protecting for risk. One is you can buy a traditional insurance product. The second is self-insurance, right? So making sure you're putting money aside to protect your family or your business in the event of an unforeseen event. The different types of exposure or loss that you can suffer are death, which again, as somebody who's been in the business for 20 years, that's an easy topic for me to talk about because it is really important. And at the end of the day, not talking about it can lead to some serious problems if something does happen. The other area that we need to always look at and talk about is disability. So life insurance protects those you love. So they are the ones that get the check in the event that you pass away. Disability is what I would call more self-centered insurance because it does pay you in the event that you're disabled. In Canada, 1 in 5 Canadians will experience a disability in their lifetime that will last up to 5 years. And so the risk of disability in many cases, especially when you're in your prime income years, is higher than your risk of death. So making sure you're protected is really important. There's a variety of different ways that you can get protection from being disabled. Group insurance plans will offer coverage. Make sure you know what the contracts state. You can buy individual insurance as well. If you're a business owner, it's really important to take a look at this because it can have a significant impact on your business and the growth of that business. What is your greatest asset? Most clients will answer that their home is their greatest asset. Their business might be their greatest asset. If they've got land or, a farm, those are their greatest assets. But those are all incorrect answers. The greatest asset that you have is yourself and your ability to earn an income. There's a story that goes that you're a money printing machine. So if you had a money printing machine in your basement, would you insure that money printing machine? You have to look at that money printing machine as yourself and your ability to earn an income. A lot of people mistakenly assume that they have adequate coverage through group insurance plans or different association plans. What I would suggest is that with your advisor, you take a look at the coverages you have to make sure that you have the adequate coverage to actually replace the income that you'd be losing in the event that you're unable to work. So everybody knows somebody that has suffered one of the top 3 critical illnesses in Canada. So that's heart disease, cancer, and stroke. There's actually insurance available to cover critical illnesses. It's called critical illness insurance. And what it does is it pays you in the event that you become critically ill. The purpose behind that is quite simple. It's to give you the freedom to seek the care that you need, to live the life that you want to live. You can pay down debts. You can actually do anything you want with it. And it's there to give you some freedom and some flexibility. You don't need to be employed to qualify for critical illness insurance, but it's certainly something that you should look to adding to your plan. So when you're working with your advisor, have that conversation as to whether or not critical illness makes sense for you. There's also property and commercial insurance and things like that. I'm not going to go into detail about those, but that's all part of a good risk management plan. When you're looking at risk management, there's a couple of questions that you need to ask yourself. 1, where would the money come if I were to die or pass away? Where would the money come if I was unable to work, whether from disability or sickness? What would happen if my spouse suddenly passed away or became disabled or sick? And what kind of life do I want to have, or do I want my family to have in the event of the unexpected? So some of the more challenging conversations I've had in my planning career have been around insurance and whether or not clients and families want to pay for insurance. So there's a couple of different ways that we can look to protect for risk. One is through obviously the traditional insurance and purchasing insurance for the various risks that you might have. The other is self-insurance, right? So that concept of there is money someplace to cover for those needs when they arise. The one thing I would recommend that you do when you're working with your advisor and your integrated team is to make sure that the concept for self-insurance isn't pulling money away from your retirement plan. So, if you have built up a nest egg of $1 million for retirement, all of a sudden you're 45 years old and you become disabled and are unable to work, you could easily eat through your retirement savings, hence changing your whole entire life plan. So again, the importance of working with an advisor, a financial planner, your tax planner is really key. So the fourth area of financial planning that the Standard Council asks us to look at is tax planning. So I will state I am not an accountant, but I have worked with accountants my entire career. And at the end of the day, when you're looking at a financial plan, tax implications can make or break your objectives. So it's really important specifically in tax planning that you're working with your integrated team. You've got your planner, your tax advisor, looking at the various sources of income you have, the structures within your company, your business. So making sure that your various tax planning strategies are coordinated versus being at odds. So I've met with clients where they have 2 different objectives and they're working with their accountant on one, they've come to meet me, they've got a personal strategy, they haven't told that to their accountant. And so what you have then is a simple example, this is one I often use. Keeping money in a business often is the most tax preferred strategy. If you want to pay down a mortgage and all you have is income from your business, you have to take money out of your business, which may not be as tax preferred. But emotionally, you might need that mortgage to be paid off. And if that's the case, you need to find a balance between two different strategies. And so those are the conversations that you want to be having. Those are the discussions that you want to be having, looking at the numbers, but beyond the numbers, understanding what your core motivators are. So integrated planning means integrating both your business and your personal life. And there's no area where that is more true than tax planning, because it's often the area where we see the most disconnect between what's happening on the business side and on the personal side. And there are so many opportunities to be gained by integrating, by looking at both sides to make sure that you've structured a financial plan that meets all your personal as well as your business objectives. So the fifth area to look at in financial planning is retirement planning. And we could do a whole video series on retirement planning and all the different ins and outs, but I'll speak on a few of the high-level concepts. 30 to 50 years ago, I think about my parents, most people worked with one company their entire career, and they retired with a pension and a gold watch. And that was really what retirement looked like. Today, retirement looks different for most people. Most people don't work with one company for their entire career. They probably move through 12 to 15 different careers or career changes till retirement age. So retirement planning is crucial because the government's not taking care of you, your company's not taking care of you. You need to make sure that you put a plan in place that will ensure that your retirement is enjoyable. With people living longer, retirement becomes a much bigger topic, and it's something that, you know, from our perspective, retirement should be living retirement on your own terms, and retirement looks different for every single client. And, you know, some people want to retire, full stop, they're done work, they've got other things they want to do. Others would like to partially work part-time. Others would like to spend more time on philanthropic or volunteer activities. So it really is, it's different for everybody. And again, that brings back the idea of working with the planner, having great conversations about what that looks like, what that transition looks like. It's key. Because what your friend down the street or your best buddy, you know, at the golf course does is not necessarily what you want to do. And the assets or the revenue that you need in retirement also differs and varies greatly by individual. So I remember, you know, this is probably some time ago, but the whole concept of Freedom 55, and it was a great campaign. And most people, even today, if you say Freedom 55, they kind of think, oh, that would be great. At the end of the day, there is no magic number. There's no magic amount of money that you need in retirement. But given what you want to do, that's where you've got to start. Lots of retirement calculators out there. Your financial planner has retirement calculators that they'll work through. You look at a couple of different things in retirement. It's no different than your financial management, right? So you've got your budget, money in, money out. Where is the income coming from? Those are really important discussions because normally by that point you might have various income sources. Making sure you manage how that money is coming out is important. So retirement for those that have, you know, that work at a company and, you know, there's retirement age and 65 comes or 60 or whatever that looks like. For business owners, retirement is an entirely different discussion. And retirement can come in a variety of different ways. It might be the sale of a business, and it is something that you've planned to do. It might be the unforeseen sale of a business. It may be that your health is impacted to such an extent that you need to make a change. Whatever that looks like, retirement planning for the business owner is one where you want to bring in your professional team, your integrated team, to make sure that you look at all the different aspects of what that might be and how that might look. All planning has two sides to it, and retirement planning is no different. There's the numerical side, so there's the head, and then there's the heart. One of the things I've found working with clients is that it's the heart that's often the most complicated to navigate during retirement and planning for retirement. It's a big change. Going from one state to another state seems really simple and it seems really exciting, but making sure that you have really good conversations with your spouse, if you have one, making sure you have really good conversations with your planner, your trusted tax advisor is really crucial and key. And there's some great books and some great resources that are available to walk you through how you do that transition, because there are only so many trips that can be planned and done. There are only so many bucket items that happen. So given the current advances in medical technology and how long people are living, for example, my grandma is 104 and she still lives on her own, we could easily live as long in retirement as we live in our working life. We're talking about retirement planning. It used to be, when I started in the business, that we'd spend hours and hours building these fancy binders, and we plop that in front of a client, and the objective is if you do everything in this binder, it's going to be okay. At the end of the day, life is fluid. Your planning should be fluid. So a common misconception in retirement is that you need less money, and that's not always the case. Oftentimes people spend more in the first couple years of retirement than they spent while they were working. So that's something to keep in mind. The other thing is, I've worked with clients that have retired with $750,000 and have had a very comfortable retirement for two. I've also worked with clients who have millions of dollars who aren't ready to retire because they don't have the income that they want to receive. So retirement planning is not one size fits all. The number isn't one size fits all. It's important to find what works for you. So last but not least, the final area to look at in financial planning is estate planning and legal aspects. So again, I will state for the record, I am not a lawyer. I have worked with lawyers throughout my career as part of the integrated planning teams, but there are some core areas that you need to take into consideration as you're working through your financial plan. Number one, and probably the number one recommendation I've made in my career is, do you have a will? Only 49% of Canadians have a will in place. And I would suggest that of that 49%, there's a percentage of them that aren't up to date. And that's really important. If there's one thing that you take away from the estate planning side, is make sure you have a current and valid will in place. The biggest excuse that we hear on the planning side is, I'm too young, I don't need that, there's nothing's going to happen to me. Well, I've seen many situations where, a client passes away and the will is old, or there is no will in place, and it creates an absolute disaster for the loved ones that are left behind. So if you die without a will, it's called dying intestate. And what that means is, effectively, the government will decide what happens with your estate. Who is going to take care of your estate? And what are the three aspects that kind of come into play? So we talked about the will, so that makes sense. It's also important to have a power of attorney. So who is that person that you designate to take care of your affairs in the event that you are incapacitated and can't make your own decisions? There's also a personal directive for health. So in estate planning, one of the most important decisions that you can make is who will be the executor to your estate. That sounds easy, but that's really tough. And those of us who've been executors or worked with executor teams often say that if you don't like somebody, ask them to be your executor. It is a really tough job, and what you can do to make sure that it is as easy as can be and is as smooth as possible is to make sure you have your affairs in order. There are two other pieces of documentation that you want to make sure you have in place from an estate planning perspective. One is a power of attorney. So making sure that in the event you are unable to make your own decisions, financially, things like that, that you have somebody that you trust that can do that. Some people like to appoint two people. That's fine as well. Just make sure they're in the same province. There's some things that you want to keep in mind to keep things simple. The other one is a personal directive for health. That one's often overlooked, and it does not have to be the same individual that you appoint as your power of attorney. The person that you appoint for your personal directive for health is that individual where if there is a health decision to be made, they are the ones to make that decision. They have the authority to make that decision if you're unable to do so. As it pertains to a will, there's one thing that people need to keep in mind. Divorce does not nullify a will. So we often see people come in with old wills. They're divorced and they believe that their will doesn't come into play, but it does. So if you're divorced and you haven't updated your will, your estate could very well go to somebody you don't want it to. So one of the other key areas to look at when it comes to estate planning is shareholder and partnership agreements. I'm not going to get into a ton of detail on those, as you should be working with your professional team of planners, CPAs, and lawyers. But there's 3 topic areas that you want to cover when you're looking at your shareholder agreement. The 3 topic areas, often called the 3 Ds. The first is what happens in the event of death. The second is what happens in the event of disability. And the third is what happens in the event of dissolution. So the company dissolves itself. So planning is complex. Business planning is even more complex. So proper planning is important for everyone, and business owners even more so. So working with that A-team, that integrated team of lawyers, accountants, planners, is really key to making sure that your goals and objectives and what you intended to happen for your business is actually what happens. Financial planning can be really daunting. And the reason why most people find it daunting is because they think of it as one event. Planning is a journey, and it's something that is living and breathing. It's not a one-time event where you go and you plop some numbers into a system and you spit out a binder and you walk away and, I wish you the best of luck. You want to make sure that you have regular touch points with your planning team and with your integrated team. You want to be able to make adjustments and changes as things change and adjust in your life. And really that living, breathing financial plan will bring you the best life that you can live. So one thing I always tell my clients is planning isn't all about the numbers. So it's not about what is that magic retirement number or how much do I need to save. It's important to understand when you're planning that there are lots of math answers, but make sure that you take into account kind of where your heart is at, what's important to you, what your values are, and if you're able to meld your head and your heart, you will actually come up with the best financial plan for you and your family. If you enjoyed what you heard and you learned something new, feel free to press like or subscribe to our channel so that you can continue to get great updates on financial planning. Click the link below if you'd like access to some of our free resources to help you in your financial planning journey. Make sure you reach out to your financial advisor or CPA to make sure you have the right A-team behind you to reach your business and personal goals.